I asked you guys on Instagram what your biggest challenge was when it came to buying your first rental property, and the biggest answer I got was, I don't have money. Back when I started out investing, when I was 26 living in New York City, home prices were nuts then too. I remember I was looking at a property, it was a co-op nearby at $550,000, and that was so cheap compared to the next property up was like $700,000. It was a studio. That property would never rent for enough for me to make money from it. Looking at that being the absolute cheapest property, I felt like I never would have had enough money, and I was making a pretty good salary as a software engineer living in New York. This thought that I never actually had enough money to get started was what basically held me back for 4 years, that on top of being scared. That was back in 2019, and since I've started investing, there's been a set of new companies that have come out that actually allow you to invest with less money down. So let's break down the options you have to invest with little money, some as low as $1. This video is brought to you by Split Brick Finance, a platform that allows you to invest in real estate in multiple markets around the US with as little as $1 while still having control over your properties. More on that later. So the first option you have obviously is doing it yourself. This is when you go all out, doing all the work, finding the property, meeting the real estate agents, all that jazz. Now, this is the method that I choose because when I started out, there weren't really many other options for me to do anything with. The pros of doing the investing of yourself are, first, that you get to have full control of the property. Like a business, you get to control the outcome by changing certain things in the property. Maybe you change the exit strategy or how you're going to improve it. Control is one of the main reasons why a lot of people invest in real estate over other assets, because with stocks and bonds and crypto, you don't have any control. The second pro is that the better your financial situation, the better your financing options. If you're someone who's good financially, meaning you got good credit score, you got money saved, you got a job or some good real estate experience, you'll be able to get a loan pretty easy and you'll get a lower interest rate than someone else who might have worse credit score or less money down. And the last one is that you get 100% of the profit. When you own the real estate and you're doing the work and you rent it out, you get all the profit because you are the 100% owner of the property. Now, if you have a partner, that might change it a little bit based on your partnership percentage, but being the sole owner allows you to maximize the amount of profits you have. But investing by yourself is not all perfect, so let's go over a few options why you might not want to do this. You actually need to be good financially, and most people are not. 70% of people do not have $1,000 saved in their bank account. Now, there's tons of ways to get your down payment lowered, but it's still really hard to buy real estate if your credit score is terrible or you got tons of debt. And even then, investing right now with a mortgage at an 8% interest rate gets hard for a lot of people in certain markets. So if you could buy without a mortgage, it'd be ideal because you'd make more cash flow, but you obviously have to have the cash for that. Second con is that you actually need to do the work yourself. Don't get me wrong, you can outsource some of the work like I do. I have contractors, property managers, and real estate agents, but you'll still need to manage the asset yourself unless if you hire an asset manager and pay them a salary, which most of you won't be able to do up front. You can't just 100% set it and forget it like you would with the stock or crypto. Sometimes you need to deal with evictions or headaches or nightmares at the property. Just part of what you're doing. And third, all of your money is in one property. So if you're starting out and you put all your money in one property and something goes wrong with that property, you're gonna have a higher risk than someone else who has their money split across multiple properties, or they have less money in on each property. The lower money you have on each property, the lower your risk. Now again, this is short term. As the properties, as you get more, this ends up reducing over time, but when you start out, this ends up being high per property. Investing by yourself is good for you if you are the following person. You're a control freak like me, and you want to make sure that everything is under your control. You want full ownership. You have the time on your hands to be able to deal with any issues that come up or be the asset manager, or you're in a good financial standing yourself to invest in real estate. Now, the next way you can invest in real estate is using REITs. REITs stand for Real Estate Investment Trusts, and this is when you actually invest in a company that owns real estate, not in the real estate themselves. This is similar to a stock where you own shares in a company, but the company's profits are real estate owned. The pros of a REIT are, this is completely passive. Think just like a stock, a bond, or crypto. You invest the money in the REIT and you get a return. And you don't even have to really know anything about real estate investing if you really wanted to. Second thing is that it's diversified. You can invest your money in multiple REITs. Let's say you had a couple $1,000 and you want to invest 1,000 here, 1,000 here, 1,000 there. You could do that if you wanted to. And if each REIT is in a different type of real estate investing, like one's in commercial, one's in residential, one's in apartments, one's in storage facilities, then you end up diversifying your income across multiple companies and across multiple various types of real estate. And all of those people might operate in different markets around the United States, which actually make you even more diversified. And the third is you don't need that much money to do this. If you invest by yourself, you typically need to come to the table with the down payment at least. And that down payment can get lower and lower lower and lower, and we've talked about ways of doing that here on this channel or on TikTok or Instagram, wherever. Depending on which company you invest in, you're gonna be buying that company at a share price. So for example, at the time I'm recording this, you only need $103 to invest in a REIT known as Alexandria Real Estate Equities Common Stock. But again, you're not owning the real estate here, you're just owning a portion of that company. Now the cons of REITs are you have zero control. With a REIT, you don't get to select the property, you don't get to select the market, you don't get to select the type of real estate, you don't get to make any decisions at all, except what company you invest in. Now you can choose a company to invest in based on the decisions they've made, so that gives you a little bit of control, but controlling the actual outcome of how the real estate comes out, you don't have any of that. Second is that there's less profitability than you would if you actually did it yourself. Because you don't control the outcome, you're probably gonna make less money. You can't pivot and change what the company's doing to maybe get a more profitable exit strategy or refinance a property to use that to buy more properties. Everything that I teach you on this channel, from everything that I've learned, you can't really use. And you're just gonna need to hope that people are doing the right thing. And third, which goes along with the last one, is that these companies have higher fees. Because they're a company, they're gonna have employees. And those employees have to get paid from the profits that they make on the real estate, which reduces their profitability of what they can give you back. Admin expenses on a lot of these companies are somewhere between 10 and 28% of the net operating income, which is a lot of money sometimes. Now, REITs are a good option for you if you're someone who has little money and you don't really care about controlling the outcome. Or you're someone who has a crap ton of money and you don't want to learn about real estate investing. And so you give all your money to a REIT, so you want to make some profits from real estate. Now, the last option is real estate crowdfunding. This is when a group of people come together on a platform to invest some money each, and then they end up buying a property together. Split Brick Finance, our sponsor, is one of these. Here's some of the pros of using Split Brick. First up, you got democratic control. You and everyone else that invests in a property on that platform have a say in what is done with the property. You get to vote, or you could bring up proposals and start votes yourself. You can talk about what contractors to use, what property management companies to use, or should you sell or rent the property. Second pro is that you actually have choice of what property to invest in. Unlike a REIT where you have no choice of what property you're investing in, you could actually put up your own properties on the platform that you would like to invest in and have other people invest with you. Third is that you can invest with little money. On Split Brick, you can invest with as little as $1 to have some equity in a rental property. Anyone can afford that. Fourth is that this is mostly passive. When you partner with other people, you usually need to create an LLC, have some bookkeeping, creating an operating agreement, using a lawyer or a CPA, get your taxes done every year, be on the phone with real estate agents when property issues come up. Split Brick, actually, as the third-party provider in this whole thing, helps you with all of that. They create the LLC for you. They do the bookkeeping and taxes and make it really easy for you to start. They also will submit offers on your behalf through an LLC that they create for you, which means you don't have to hop on any calls with any real estate agents. The fifth pro is that with Split Brick, you could diversify and reduce your risk. You could choose to invest in different properties in multiple areas around the United States. This can reduce your risk, just like if you invested in REITs with more control. Now, Split Brick isn't a perfect platform, but there's a few cons that I wanted to highlight here. One is you don't have complete control. If you own the property yourself, you would have 100% control. With any partnership you enter, you're gonna have to deal with the partners. So even though you have control by voting and proposing things, you still need to get things passed by other people that are your partners. You can't just decide what you want to do it and make the decision for everyone else. Split Brick will actually act as a mediator in these decisions, which is great. It makes it a lot easier to make decisions across partners, but still possible for people to vote against you in different things that you'd like. Two, it's a newer platform. There aren't that many investors on there yet, but over time, as this platform grows and as more people watch this video, you'll have more people investing on the platform, making you have an unlimited source of funding for all of your deals that you end up putting on there. Now, Split Brick is a great option for you if you're this type of person. You're someone who wants to diversify. You want to reduce the risk of investing all of your money in one property by going in with other people, but you still want to have control over the outcome. Or you could be someone that doesn't have all of the money to invest in a property themselves, but wants to get some experience getting started. It's a solid middle ground where they give you control over the property with a lower down payment, a lower amount that you'd be able to get in most property scenarios, while still having a high amount of property choice with with a lower time investment than most investments. Now, you shouldn't be using SplitBrick if you're this type of person. If you're afraid of having partners that you don't know, and you aren't okay with a third-party platform like SplitBrick managing the whole thing, or if you're someone who wants absolute control without getting the approval of other people, and you're someone who's okay with more risk. Now, if you want to sign up for SplitBrick, you can use the link in the description, as you'd be supporting my channel, and you could get started investing today. Let's dive into the platform so I can show you a little bit about how the whole thing works. So when you head over to the URL, you click invest, you sign up, and then you go to your community. This here has the current properties that are in ISO and the properties that are currently under proposal. And so let me show you a little bit about how the process works. Step one is to find a property that you think is going to be a good investment that you want to put on the platform. Step two is to go to SplitBrick and then create a proposal like any of these, telling people about why it's a good deal. Then the properties that are under proposal will get voted by its members. So as you can see here, this property only has 1 upvote, this one has 4, and this one has 11. If you don't have a property you want to bring, that's okay. You can just come here and vote on other people's properties. Every week or two, the top voted property will get moved to the bidding stage. That's where it is up here, this other one with the ISO. So people will then bid on the property using the following: the amount of money that they want to lock up and the amount they want to purchase the property for. And so you enter that information here, the amount you want to invest and the up to what purchase price you're willing to buy it at. If for some reason the property gets bid higher than your purchase price, then guess what? You'll get your money back immediately and you won't be bid on it, because you make your money when you buy if you know anything about real estate. SplitBrick's bidding system allows you to make sure that when you're bidding, you don't end up overpaying for a property. Now, if your bid matches with everyone else's, then SplitBrick will make an offer on your behalf. If it's accepted, they'll handle the inspection and they'll share the inspection with you. And then if everything goes well during the due diligence period, SplitBrick will handle the lawyers, the insurance, LLC creation, and accounting from that moment on. These are paid for by SplitBrick charging an extra 5% of the purchase price of the property when you raise your funds in the beginning. Then either SplitBrick can pick a property management company for you, or you can yourself. Then the property's yours and you can vote and propose things all within your portal here. So I'm going to pick a random property and show you how you're going to create a proposal on this platform if you want to bring properties yourself. So I'm going to head over to Zillow. And I look for properties in Akron, Ohio, most recently. So let's look at Akron, and definitely not that high of a price, but let's go max 150 for sale, home type, multifamily. I like multifamilies. Now, I'm going to stick to this area here, 110. Cool. So this will be my first time creating a proposal. Let's see if we can create one. New draft. Okay. Enter address. So I'm going to copy this address here. Copy this address here. Property information, save address, and continue. Now we're going to add information from the listing. 5 beds, 2 bath. Square feet, 3,036. Build year, 1926. A lot of homes in these areas are built that long. Suggested valuation, it's asking 110. So I'm going to look at some of the pictures here. These ceilings are weird, right? Copy image. Property type, multifamily house. Tenants pay all utilities. I'm going to put what it has here as my starting point. I'm going to say Zillow information. Duplex in great area of Akron. Bidding length, 7 days. Property manager fee. So I have a property manager in the area, so I'm going to put 11% annual gross rent. So if it says upstairs 3 bed, 1 bath. So I'm going to go to Rentometer and I'm going to look at what the rents are going to be in that area. I'm going to add the address and do a 3 bed, 1 bath. Analyze 1,000, 2 bed, 1 bath, 800. So we're going to go 1,800. Annual property taxes. All right, so I'm going to have to go to PropStream here and look up the property taxes that they have. Sometimes the property hasn't been coming up properly. 38 Alpharetta. We got to find the house here. 38.5. Here we go. Details. So here we got the owner information, tax information. In 2022, 1,243. Annual property taxes, suggested valuation. I'm just going to put it at the purchase price of the house. Miscellaneous expenses. So I'm going to save, let's call it 20% of the monthly rent, $360. And then I'm going to add some pictures here because we don't have any pictures of the property. Full pictures. All right. Cool. And so I'm going to publish. It's been published. So let's go through. We can go to proposals here. And so now it should be over here and people can vote this one up. So I'm going to be biased and vote this property up. Anyone else can vote their properties up as well. So I can vote this one down or up. I'm not going to do that because I haven't looked at the deals, but that's how you would do this whole thing. And so if you want to get started investing today with as little as $1, you should check out SplitBrick using my code, as you'll be helping out the channel and it can help you get started without having to wait to save as much money as you think you need for your first investment property. And I'll catch you all in the next one. Peace.